We've heard a lot over the last day or so about the models that do not work or that are not working, in particular commercial banking, and the challenges that smallholder farmers face. So during this session, I would like you, the experts, to talk about your experiences in approaches to creating and designing financing facilities. So I think where we'll start is maybe a short introduction from each of you on where you fall in this space. Let's start with you, Alice.
Well, thank you so much, and it's a great honor to be with you all. Thank you so much to African Development Bank friends for welcoming me here. It's been just wonderful to be here. In speaking with Martin and Debisi about this, I think the question that came up was, how did we put together a financing facility for immunization? And so let me take us back, if I may, very briefly to November 2003. And the question, I worked at Gavi at the time, the question on the table was, how did we scale up the availability of financing for purchasing vaccines at a time when things were very, very fragmented? I looked on the website of what was called the IFM before I came here to see how it's going. To date, it was a dream in 2003. We launched it in 2006. To date, before I got here, it's raised $9.7 billion, 42 bonds, 8 currencies, with multiple types of bonds. So dreams are possible. So just a couple of thoughts about what we did then. We were very clear about the problem we were trying to solve, and it was a lack of financing for what was then a pretty unclear market in terms of demand for vaccines. The design challenge, we really tried to solve a few things. How did we scale the financing and really make the cost of the financing efficient? How did we understand the risks of the capital stack that we put together? One thing that's very different from the IFM to the smallholder farmer challenge is that we were not financing the delivery of actual vaccines, we were financing the purchase of vaccines. So quite a different problem. But we were also very clear about the public policy challenge that we were trying to address, which was putting together a financing facility that borrowed at just a few basis points more than what the underlying borrowers were borrowing at. Was that worth it compared to being able to reach herd immunity faster? So we were very clear about those challenges. We also had huge political will behind us. We had 6 governments, plus the Gates Foundation, very much driving doing this. With all the great humility, let me maybe make some thoughts about some of the challenges that I see here. And I base this on the work that MCC did in part in the compact design in Zambia, in Malawi, and Lesotho. The public policy rationale for getting finance to smallholder farmers seems absolutely clear. And not only in terms of the employment side, but also the food security, and as President Adesina has just said, the food sovereignty side. The design challenge, I think, has some real differences, though, from what we were trying to do at IFM. What we were doing in immunization, we were not necessarily taking the risk of delivery of vaccines. Here, I think one of the big challenges is the question of risk. And how do you put together a capital stack that can withstand the many risks that seem to be present with smallholder farmers? I think, take your point, President Adesina, and that many others have made, which is perhaps people are misunderstanding the risk. And there's been some very, I think, creative ideas put forward about how do you switch from using traditional credit type of risk to other types of information, which are going to be available in the MAID Alliance, the Community Pass, and lots of other things that are being put together. So there's a question of risk in the capital stack. But there's also so many creative ideas around that I think there's a lot of terrific ideas that can be brought to bear. I also think there's a question about how you aggregate and scale the smallholder farmers, and there's a lot of, I think, great work being done on this too, into a group that can take on larger amounts of finance. So there's a finance distribution question. work that you all have done at Aceli about how to create incentives for the banks to actually lend, I think is very, very valuable. And then let me add with one point about political will. I think it would be very beneficial to try to pull together, under the auspices, of course, of the African Development Bank, a group of governments that are prepared to really get, local governments on the continent, that are prepared to really get together on this and drive both the financial environment, the policy environment, the private sector environment, to really get behind this. And I'm just thrilled, President Adesina, with the announcement that you've just made about a facility, because this strikes me as that's the table that could be set to really drive the political will around this. At a technical detail level, some of the solutions are going to be different from what we did at IFM, but a higher level, there's going to be some similarities. So I wish you all the best of luck, and I'm sure that if we put all the hands around the baobab tree, something can be done.
Thank you very much. Thank you very much, Alice. We're going to get deeper into the design and how to overcome some of the challenges, but let me first bring in Brian Milder from Aceli Africa, your founder and CEO, and you specialize, you can probably explain it better, on unlocking private capital. Just situate yourself in this discussion about financing and designing facilities to finance smallholder farmers. What specifically does Aceli Africa do and how?
Thank you, Yvonne. Thank you for the invitation. So capital, and particularly private capital, is like water. It runs downhill. And I think two stats really sum up the challenge. So the first is 14%. That's the yield that Kenyan government bonds offer and that the corporate banks are buying up. And 3%, that is the average return that banks across East Africa earn from their lending to agricultural SMEs. And so we need to bridge that gap if we want private capital to flow. In this case, and our focus as Aceli is on agricultural SMEs, and we focus there because they are aggregators, they provide market access for smallholder farmers, they create jobs along value chains. And so we set out in 2018, and I've spent about 20 years working in agricultural SME finance, and we wanted to understand this problem. And so we went around and asked banks for their data. How much do you earn from lending to agricultural SMEs? How much does it cost you? Your operating costs and not just risk. And that's where we landed on that 3%. And I think that much of this conversation around finance, whether it's focused on agricultural SMEs or smallholders, is focused on risk, which is important, but insufficient time is spent looking at cost, transaction costs. And particularly for agricultural businesses that are located several hours from urban areas where the bank branches are located, cost is a huge issue. And so we need to think about solutions that understand the full equation of profitability, including the cost of the transaction cost to go out and find and underwrite loans and monitor them, the cost of risk, and then the cost of capital that financial intermediaries, whether they're banks or others, incur. And so Aceli, we've been working for about 5 years. My colleague Richard facilitated a panel yesterday with our partners from Family Bank and an SME, Sopa Supplies here in Kenya, a food processor. And essentially we're sharing in the risk, but also defraying the high transaction costs to get banks and other lenders to extend farther, to increase their risk appetite and serve agricultural SMEs. And then those incentives are complemented by capacity building. Capacity is a huge issue. I think the president just spoke about the knowledge that exists or lack thereof in many commercial banks. Right now, the status quo for a lot of lenders is a negative cycle. Agricultural lending is not profitable or not nearly as profitable as other alternatives. The treasury of those banks don't allocate capital internally. The senior leadership don't assign resources, so you have underdeveloped agricultural departments. So there isn't much knowledge around agriculture. There's a high perception of risk, and there's very little lending. So that's the status quo, and multiple things are needed to break that status quo. But one of the big ones is to help that capital move like water downhill. And what Aceli has done is provide incentives, as I said, about $1 for every $10 that commercial lenders put into the market. And a portion of that incentive is going to subsidize the transaction costs for lenders. And I use that word subsidize very intentionally. It is highly uncomfortable for many of us to talk about subsidizing private commercial banks, which we know to be quite profitable. And so if we start from the mindset of we can't subsidize the private sector, then unfortunately, I don't think we're going to solve this problem. If we instead start from the perspective of what is the highest impact and most efficient way to get capital to where it needs to go to help it flow downhill, then we can look at the data, we can look at the challenges in the market, and we can design solutions accordingly. And in this case, I strongly believe when it comes to finance for agricultural SMEs, being willing to offer some transaction subsidy to commercial banks is critical. It activates them. So we have a partner in Tanzania, Tanzania Commercial Bank. Used to be the postal bank. They have 83 branches around the country. They're 100 years old this year. 2 years ago, 2% of their lending was going into agriculture. They had very traditional asset-backed financial products. They weren't really serving many value chains. And so with the incentives that Aceli was offering, they did a value chain study on cassava. They had developed a warehouse receipts product, but they had never deployed it. And out of their Kigoma branch in the northwest part of the country near the border with Burundi, they made 9 loans, about $800,000 of lending to SMEs that aggregate about 2,000 smallholder farmers. So all 9 of those loans repaid. And what was interesting is the bank increased their deposits at that branch by four times in one season. Because by injecting capital into that community where it hadn't been before, they were generating economic development. And so when it came to the next season, they went to head office and they got a greater capital allocation. And they made 9 more loans to those same businesses. They did an additional 8 loans that we supported. And then they did another 13 loans to cassava businesses that were below our minimum threshold. We only support loans from $15,000 up to $1.5 million. But because the bank now understood the value chain, they now had the expertise, they were willing to do that. And they were going several hours from their branch. And they also took that warehouse receipt product and began offering it in coffee and maize and rice from other branches. And so I give that example because I think too often, again, we're focused on risk and we're very worried about subsidizing the private sector, as we should be. But I think with the political will, with the willingness to work in partnership between government, donor institutions, and the private sector, we can develop these solutions that mobilize private capital.
Thank you very much, Brian, for those thoughts and that example from Tanzania. And later we can get into how some of these approaches and designs can be replicated across the continent. Jules, let me bring you into the conversation to talk to us about the Africa Guarantee Fund. Please situate AGF in this conversation and discussion about the design of financing facilities, which seems to be one of the major sort of impediments to actually supporting smallholder farmers.
Thank you. Now we'll start with one thing that Mr. President said this morning that is very critical, is how do we leverage money that already sits within the commercial bank, to finance the agricultural sector. When we look at the numbers, so today, the contribution of agriculture to the GDP in Africa is 30%. But when you look at the composition of the lending portfolio of the commercial bank, only 6% is allocated to agriculture. So only 6% for an output of 30%. So this is where the problem is, and this is what we are trying to solve. How can we increase this allocation from 6%, why not to 20 to 50%, so that the commercial bank can do more? And the reason why they're not doing so, also Mr. President mentioned it, risk. Risk is a critical factor. How do we de-risk? And when we want to de-risk, what are we de-risking? I think we need to understand how we got there. What are the real reasons the commercial banks are not comfortable with the risk coming from the agricultural sector? And we have many reasons. So say one of the reasons is the lack of information. We talk about the small farmers. Most of them are in the informal sector. They're informal, meaning it's very difficult to be able to trace the information. They don't do proper bookkeeping. So when they go to the banks, they don't have enough information, and even the bank are not in a position to do a proper risk assessment to understand the type of risk that they are taking. So lack of information is a big challenge. Another challenge is the lack of collateral. We talk about the smallholder farmers. They represent 80% of farmers, but they own less than 5% of farmland, the smaller farmers. Meaning they're already in a difficult position when they go to the bank because they don't have any forms of collateral. And the preferred forms of collateral is land. So they're already also in a difficult position. So how do we solve the issue of the lack of collateral? Another challenge is the resource gap. We tend to say that our commercial bank, they are very liquid, but the bank that normally serve the smallholder farmers are cooperative. And when you look at the structure of their resources, it tends to be short-term resources. And those farmers, they need long-term investment, to acquire equipment, storage facility, the truck, the tractors. And those banks, they have most of their resources come from the depositors. So on one side, they have 6 months deposit, but they have to finance maybe a 5-year loan. How do we resolve this mismatch? And then lastly is the product. The product that most of the banks are offering is not aligned to the farming cycle. When we talk about the farming cycle, what the farmers, they do is that when they get the money, first thing, they prepare the soil, they buy the seed, they plant, they grow the crops, they harvest, and then they go to the market. When you look at the cash flow structure, they get the inflow when they start selling. But the problem is that most of the commercial banks, they have a standard repayment schedule, a standard loan schedule, whereby those farmers from the first month, they already have to pay the monthly installment when they don't have any inflow coming in. So what we're also trying to do is to work together with those commercial banks to align the repayment schedule of the loan to the business cycle in farming. And when we even say farming, it depends on the crops. The cycle for maize is not the same cycle, for flour, for tea, for coffee. And this is where the challenge is. And you will go to all the banks, they will say, okay, they have a desk for agriculture, but do they have a product specifically for tea, a different product for coffee, a different product for maize, taking into account those cycles? And this is what we are working on to solve those issues.
Thank you very much, Jules, and thank you for your insights. We're talking about designing a facility, but I have a question, and Brian, you touched on it about profitability. Isn't the key issue the fact that there is a perception, maybe it's a reality, that it's just simply not profitable, right, to invest in finance for smallholder farmers? So it doesn't really matter what you design. Or is it more about the design making the smallholder farmer more profitable for banks and other stakeholders? Thank you, Brian.
It certainly can be profitable, but I think we need to do a lot of segmentation. Dan Zook talked about this yesterday. There are different channels to get finance flowing to smallholders. There's formal financial institutions, there's value chain actors, there's less formal institutions like village savings and loans and associations and SACCOs. And then there's needs at different parts of the value chain, the smallholders themselves, but also the cooperatives that aggregate them or the processors that offtake from them. So we need solutions that work for that whole system. And in some cases, and we saw also yesterday the representatives from MasterCard and Visa, digital and mobile wallets technology can really disrupt and create more viable business models. There are other parts of the market, and SMEs is one of them, that are harder to serve, that are costlier, and where there's a role for the public sector to play in de-risking, and in some cases also providing some targeted transaction subsidies. So I think that we can't talk narrowly about one size fits all. It's understanding the market, segmenting it, and then thinking about the combination of incentives and supporting different business models, capacity building, and policy. They have to be coordinated together.
Thank you very much, Brian, for responding to that. So let's go back to the key question of this discussion. So the design of these facilities. And Alice, you talked about your experience at Gavi, the Vaccines Alliance. Using your knowledge and experience there, how would you design a finance facility or a conduit that the African Development Bank or other institutions could actually channel financing through? How do you start to design it? What are the key steps you need to take?
Well, I speak with great humility because the African Development Bank has a wonderful team working on this, so much of this with all of you. I think Brian really touched on a very important point just now, which is that, first of all, there's many different types of finance that are necessary here. And just to draw one big distinction, there's working capital finance, which is one type of finance which has its own dynamics. And then there's infrastructure finance, which are very, very different dynamics. So what I would start with mapping. What are we really talking about? Is it both? And who are the right providers of both? And very short-term working capital finance has one set of dynamics, and big infrastructure finance, I mean, that's what my previous agency, I'm still going to call it my agency, used to do, which is huge infrastructure finance, roads, for example. We just signed a big compact with Zambia to do big road infrastructure. So I would first start mapping what are exactly the needs and who are the best providers of both of them. What are the P&L requirements? What are the risk requirements? What are the information requirements? I'm not sure that all of it has to be done in one facility. And I would also look at what's being done already that can take different pieces of it. The working capital finance versus the infrastructure finance has very different risk dynamics to it. And then I would start assembling who are the players in the market, and a lot of we heard from yesterday that can begin to take on pieces of the risk. There's also, I think, a lot of potential for diversification between countries, between different products, between different segments of the value chain. I don't want to take too much more time, but I would begin to really get into the very hard work of disaggregating what is exactly needed, who is doing what risk mechanisms can come into play, and what capital you need from all of them. The distribution mechanisms for the different types of finance are also going to be very different.
Thank you very much, Alice. Brian, how would you design a facility? What would be your approach?
Again, I agree with Alice. Doing a mapping, understanding which parts of the system you're trying to address, and then recognizing, again, that cost of capital for the financial institutions is a big piece of this. And so I know that the AFDB, IFAD, and others are working on facilities in partnership with governments to lower cost of funds. We've seen in Tanzania over the last few years, the central bank has taken money, offered it at 3% to commercial banks, 3% in Tanzanian shillings, and it's gone out into the market at 9 or 10%. And that dramatically increases the uptake and makes it feasible for SMEs to borrow and to grow their businesses. So I think there are known solutions in that part of the chain. Let's replicate those. I think we increasingly have known solutions around what it takes to activate commercial banks. And there's risk-sharing facilities like AGF and others. And then capacity building. There are no shortcuts around building capacity expertise on both the side of financial service providers and SMEs or farmers. You can't simply push credit into the market. It needs to be properly managed, and there has to be enabling policies around it. So government needs to be part of that conversation and working in coordination across these different elements. So, there's a lot of pieces, and trying to decide also which ones you're tackling and maybe not doing all of them at once, but.
Yeah. Absolutely. And Jules, I'm going to give you the last word for this panel on this design that we're talking about.
Thank you. Yeah, so in terms of design, we see that in two angles. The first one is on risk, because every investor, they look at two things, the risk and the return.
Yes.
Right? So on the risk part, this is where we offer the risking product, to make sure that we can reduce the risk that the commercial bank are taking as they're increasing their lending to the SMEs. So as much as we de-risk the commercial bank, we also de-risk the investors, the bondholder, the depositors. So we want the commercial bank to be able to mobilize long-term resources, right? But the return part is also very critical because we said earlier that it's not profitable. Agriculture is very profitable. It's extremely profitable. The challenge is the distribution of the value add. When you look at the value chain, we have some company involved in the input, that the one providing seed, fertilizer, and then some are involved in the production, of the output, and then some company are mainly on the transportation, the logistics, storage facility, the processing, the distribution. When you look at all that value chain, we have some actors that get the lion's share of the value added. You take, for example, cocoa in Africa, we only get 2% of the value added in the cocoa kind of value chain. So how do we make sure that those farmers, they can have a higher amount? The main challenge is the middlemen. We tend to have many middlemen along that value chain. And because the farmers, they don't have access to market, this is where now they don't have the bargaining power. How can we capacitate those farmers to have directly access to the market, to the company involved in processing, so that they can capture a much important part of the value that has been created? Yeah.
Thank you very much, Jules. Yes, a round of applause, I think, for the panelists. I want to... Thank you. Thank you. No, I wanted to say thank you so much for bringing your expertise and your insights to this conference. I believe the three of you are still around, so those of you who want to interact on a one-to-one level with Alice and Brian and Jules, I'm sure you'll be able to do that. So thank you again for coming to share your expertise and insights into how to design financing facilities, and I hope our audience learned a lot from your experiences.